This is Michael Fox, and this is the Prospector News Podcast. And joining me, I have National Investor CEO Chris Temple. Welcome again, Chris.
Hey, Mike, how are you?
I'm doing okay. A little bit puzzled, confused, bewildered. We've had another Fed event this week. They paused or skipped. I can't even keep the code words straight anymore.
Well, they started to use the word skip recently because pause in most people's minds, except for Webster, who created a dictionary with those terms. But in the markets these days, they were afraid that the connotation of pause actually meant that they were done hiking interest rates, and they didn't want to convey that if they could possibly help it. So that's why they started to use the word skip a bit more, so that they figured, okay, we're decelerating our rate hikes and rate hiking pace. So instead of going 25 basis points every meeting, maybe over most of the rest of the year, we go 25 basis points every other meeting. And they could have done anything, and I don't think it would have been a major shock either way to the markets. I wrote, as you know, to my audience at the beginning of the week that all else being equal, they would probably have been wise if they did raise rates again now. After all, if they're going to do it next month, why wait if the inflation is still a worry? So I think that there's some messaging in there where the Fed was trying to cover the fact that they really are somewhat flying blind here now. They don't know for sure, I think, how much more they should go. Everybody does know that it's the lag effects of 520, 500 basis points of rate hikes to this point aren't all going to be felt right away. This is going to play out over a number of months, maybe a year or longer. So we'll see. But I think they're trying to be a little bit too cute.
Yeah, cute in this particular case can get you into trouble really quickly.
Well, it can. You pointed out when we were visiting before we started recording that, with them deciding that this is the month that they were going to skip, with everybody else still having just recently raised interest rates, and at least in the case of Australia and Canada, this is after they first paused and then said, oops, we made a mistake. We need to do more because inflation is more intractable than we thought. Hell, Jerome Powell was telling us endlessly that he didn't want to do that. And it's not to the extreme of the 1970s where the Fed raised and then paused and actually cut rates for a while before they had to reverse course again and then really start raising interest rates after a while. So it's not that dire yet, but look, if the dollar is going to suffer now, and I don't think it will very much from this temporary, perhaps, differential in rate policy, well, then that's going to support commodity prices again. It's going to raise import prices for the U.S. again, as you pointed out when we were talking earlier today. And the Fed's right back with a bigger inflation problem, arguably, than it would have had maybe if they had raised rates this time. So, they probably aren't done yet. There are some people thinking that they are and just don't want to admit it. So they skipped this last meeting but still talk tough, like they're going to raise rates still 50 basis points more over the balance of the year, which that was I guess the one part of the meeting this week that was somewhat of a surprise was that, but that's only if they follow through with it. And there's some that think that it's all talk and that they don't intend to. They were just wanting to avoid another rate hike, but talk the market into believing that more was coming.
Yeah, there's a lot of talk. This was probably the first Fed meeting we've had in a while where it wasn't clear going into the meeting what they were going to do. It was probably 50-50 that they did what they did versus, raise a quarter point. The only thing that was off the table was a lowering. And I understand why they've stopped using the term pause because, the P word, that comes with the pause is pivot, and we're nowhere close to a Fed pivot that the market seems to be, chomping at the bit to get. And, employment numbers remain high. Inflation remains high, relatively speaking. And as you alluded to, they're now out of step with a lot of the Western central banks who have raised their prime rates in the last couple of weeks. And the US dollar's taken it a bit of a hit in that fashion. I'm not sure how much of an inflationary push that's going to give, given that some of the more Eastern trading partners, such as China and the likes there, they're trying to stimulate their economies still, and they've lowered their interest rates. So, there's the yin and yang out of it all.
Well, there is, and I pointed that out again also at the beginning of this week to my audience, Mike, that one of the challenges that the Fed and the other chiefly Western central banks have that are still tightening is that you've got Japan and China going completely in the opposite direction. And so that somewhat negates the whole thing. In fact, for all of the talk about liquidity and some concerns about the central banks at some point overdoing things on that front, you look at the Bank of Japan alone, and I need to update these numbers, but it was only a couple or 3 months ago that I wrote about this, that the Bank of Japan's increasing of the amount of securities in the public domain being purchased for about the last year now has all but negated quantitative tightening on the Fed's part. So you've got them going, and my cartoonist did the old Dr. Doolittle push me, pull you thing, where you got the head at both ends. Well, which direction are we going? You got kind of a Mexican standoff here in a way. So, that Japan and China have their own versions of the problem everybody does in the world. Too much debt, not enough GDP to service the debt. So you got to keep printing more money. They came about it in different ways, but at the end, the math is still the same. So China, which for all the talk earlier this year of them roaring out of the gates after their self-imposed COVID shutdown, they've hobbled out of the gates more so, and their economy is not in the best of shape. So yeah, they've eased policy. That's going to keep at least a floor on commodity prices. And so getting back to your original point about the dollar, if the dollar is going to weaken anew again after it had a decent rally in the last month or so from a key bottom that it made, then all else being equal, it keeps the price pressures percolating under commodities. And to add to that, of course, as the Fed continues to remind us, and even after their announcement on Wednesday, there's been 3 Fed governors and bank presidents that I've seen just since yesterday that have reminded us, we really mean it. If core inflation doesn't come down, I will support raising rates again, even though we skipped this last one. So okay, well, we'll believe it when we see it. But I think that what is not being addressed enough with the worries about core inflation and a lot of stuff are the things, and you and I have talked about this in other contexts before, where a number of things have changed for our respective nations as well as globally that have taken away the many forces that for 40 some odd years really did lead to disinflation. Now we're going in the other direction. And so this idea to begin with, and I don't know how the Fed does this in the end, but the idea to begin with that there is any easy way to get back to a sustained 2% inflation target to start with is a fantasy in the world that we're in now. It wasn't a fantasy 10 or 15, 20, 30 years ago. It's a fantasy now because too many things have changed. They're going to keep permanent pressure higher on prices, including for commodities.
Well, yeah, if we're moving from a deglobalization platform where people are starting to nationalize industry back to their home countries, that's going to be inflationary for the West because we don't produce those goods at the same cheap prices the Eastern and the developing economies were producing them.
Very much so.
Unless, as you say, we move back to a Monroe doctrine, and instead of, exporting our production to China, we export it to, say, South America.
Well,
But
we'll see. I posted earlier today a great opinion piece out of the Canadian Mining Journal that, and I'm paraphrasing this guy right now, that it used to be that he who has the gold makes the rules, but going forward, it's going to be he who has the lithium, the nickel, the cobalt, the uranium, the copper, all of those things, they're going to make the rules. And a disproportionate amount of that globally are these various resources in emerging nations or non-Western nations more generally. And up until recently, and some of them still now, they get a pittance for their resources that they export to the US or to Europe or China. And those days are ending. And so for a lot of these different commodities, the countries in South America and East Asia and Africa they're gonna command, and properly so, on a number of fronts, dear prices for these resources because they've got them. And that is going to increase the cost structure of a lot of these things globally. Not to mention, the lingering cost pressures because of all the money that was printed for 2 years, in the name of the pandemic. And, that you're not going to take away the effect of that anytime real soon. In fact, you and I also were talking earlier off mic about a good piece that Kitco carried, I think they posted yesterday, by Professor Steve Hanke, where he's concerned that the Fed is flying blind, that the M2, the broad measure of the money supply, has dropped by 4.6% year over year, and that never happens without a recession. But as much respect as I have for him, I think that you've got to mitigate that by acknowledging that before you had that drop, you had an unprecedented 30% or so increase in M2 in the 2 years prior to what he's worried about. So they can still shrink the money supply a fair bit, and you're not necessarily going to have a deflation right away.
Yeah, I was reading a contrary piece to that suggested that the Fed has an awful long ways to go by retracting their balance sheet and shrinking the money supply before they can actually do any real damage to the economy. And so far, that's been bore out by, we still
Yeah.
have record low unemployment rates, and at a time when we've raised interest rates by 500 basis points in a very short period of time. If I went back to my economics 101 and I suggested that to a professor, I think they would have been fitting me for a straitjacket.
Yeah, well, a lot of things that have happened in the recent past is kind of like a combination of I don't know what crazy movie characters you want to put out there, but you've got people who are anything but rational economists who are making a lot of these decisions these days.
Yeah. For the audience, I shared a picture with Chris on Facebook. We're Facebook friends as well as friends in real life. We caught our Fed chair at a Grateful Dead concert, so we now know he's actually smoking something.
Yeah, that was pretty good. That made the rounds a lot.
But yeah, I think the Fed isn't done. I think that I'm surprised that they've paused, skipped. I'm thinking that there's at least, and I'm more hawkish than they are. I think there's another maybe 3 or 4 quarter point jumps coming, but maybe not this year, but going into 2024. In order to tame inflation, the interest rates have to be higher than the inflation rate, and they've got a ways to go yet.
Yeah, I mean, the short end of the yield curve, a couple of those measures now are above the core rate of inflation. Historically, a tight monetary policy, or one designed to, lead to a reduction of inflation and et cetera would be 2% above the core inflation rate. And we'll leave aside for the moment how that number in the first place is massaged these days, and very likely understates what real world inflation is. But I think what the Fed would be happier with, and the market just hasn't cooperated for a lot of reasons, largely because they don't believe the Fed. From time to time, the market no sooner started to come around to the idea that, well, maybe there isn't going to be a rate cut after all in 2023. They took the Fed funds futures market, took that off the table. Now they're out of line with the new dot plot projection, which forecasts 5.6%. So that's 50 basis points more in hikes over the balance of the year. The market doesn't believe it. And where that is most felt is at the long end, where you look, from 5 years out, and certainly 10 and 30, where you still have a greatly inverted yield curve, where nobody believes that this policy of higher for longer is going to last terribly long. And that, to me, is the Fed's biggest problem. And it's compounded by this perception. And it's not inaccurate, Mike, and maybe this is a lesson for people today. It's not inaccurate to say that an inverted yield curve typically leads to a recession or is a harbinger of a recession. All right, because one of the things that means is that it becomes less profitable for a lot of lending activity to be made if it costs a financial institution more to borrow money short, but they can't make up for that borrowing money or lending money out for a long time as well as they could under normal circumstances with the steeper, upward sloping yield curve. So a lot of that has come about, though, I think, because of speculation. You've got people in the markets who simply are betting that the Fed is not going to be able to follow through. It's not like they're betting on a recession per se by buying long-term treasuries. They're just trying to get out ahead of the Fed's coming someday pivot, which will happen. I think not as fast as some think, but it will happen. Just not as happen as some people, not as fast as some people believe it will. So that's why the long end is still very subdued. And I think you've also got this dynamic I mentioned earlier, where Japan is still inflating the monetary base wildly, and some of that money is going into foreign assets, including into treasuries, because there's still a monstrous differential between the currencies and interest rate levels between Japan and the US. So it's free money if you're playing the yen carry trade game again. So that is cross purposes of what the Fed is trying to do. That's why they're going to continue to roll off their balance sheet. It won't shock me, and remember where you heard it first, folks, that as we go through the remainder of 2023, even if the Fed does not want to raise rates anymore, don't be surprised if they increase the rate by which they roll off their balance sheet, because that will help to finally push rates up across the rest of the yield curve a bit more. I mean, I understand a lot of the balance sheet is still, relatively shorter dated, but not all of it is, and certainly not where mortgages are concerned. So it won't shock me to see them do that, because they would be happier with life right now if the long end of the yield curve was at least in line with what the federal funds rate is.
Yeah, no doubt. The other question I have with this, though, is the market's reaction doesn't seem to be in line with what the Fed is saying. But the last time that we were faced with situations of this level of inflation and this rapid increase in interest rates, we go back to the mid 1970s. And how many people on Wall Street today were around in the 1970s to see this the last time? And, maybe they skipped that day in history class.
Well, and that's a problem too. That's another thing that's messing up things for the Fed, Mike, is that, you've got people today whose muscle memory, so to speak, is much more of the idea of the Fed put. And still, despite, 500 basis points of rate hikes going back close to a year and a half now, or going on a year and a half, and the Fed's still talking tough, a lot of people still don't believe it because it's not the world that they know. I mean, you did have a tightening cycle comparable to this in a way from maybe 2004 through 2007, and in that time frame, as the weak dollar and the inflation, and a lot of it back then was demand driven by China building the equivalent of the city of Houston every month. And that had commodities on fire, as a lot of people, especially if you invested in them, happily remember from around 2002 through 2007 and 8. And the Fed had already paused back then under Greenspan, who then passed off the burning baton to Bernanke. They had already paused for quite a while before everything collapsed in 2008. They weren't still raising rates into that. So there were cracks underneath the surface of things that people started to worry about, but it wasn't felt widespread until it was all at once. So you had that, but even going back to then, the response afterwards, and really since, was of the Fed that always has in mind that it wants to continue to support asset prices, support the animal spirits, and so part of the Fed's fight right now, as we've said, not to belabor it any further, is that a big part of the market really doesn't believe it because they've never had to live it.
No, they haven't. As much as I can recall it, I was barely in junior high the last time we had situations like this, and I remember it being on the news, but as a 13-year-old kid, it certainly wasn't affecting my day to day.
Yeah.
So
So we'll see. I mean, my base case, and look, any of us that do what we do, especially me, where I've got to make, at least some reasoned judgments out of which way do I think the market is going, and how do we, work our asset allocation, and address different sectors or not address different sectors. Do we go aggressively long, or do we hedge with short positions? All of these different things. What you look at all the probabilities out there, and you try and pose a base case. My base case is, and continues to be, that we have entered the great stagflation. The economy will inevitably bog down further. We may not go off a cliff, but things are going to slowly, grind lower. The financial markets inevitably will finally reflect that, but maybe not dramatically. Even coming into this year, where I think the low in the S&P 500, before it's had this rally in recent months, we were down in the 3,600 area or whatever. I said, look, maybe in a worst case scenario, a good bear market, we go down to 2,800 or 3,000. Maybe we've already seen the bottom in the S&P 500 because there is still so much liquidity out there. I don't know. I certainly wouldn't be chasing the market at these levels right now, because this has gotten to be a little stupid. Whether you believe the Fed's going to raise rates again or not, because if it turns out that they don't raise rates any further, and the people betting on risk assets are correct, well, why is it that they didn't raise rates any further? It's because the economy is deteriorating a lot faster, and a lot of corporate profits with it. So either way you look at it, you're going to have subdued earnings going forward. You're going to have a subdued economy going forward, but still in a world where inflation at the core, or any of these levels, is going to remain well above 2%. And that's a definition of stagflation. So are there dangers of an outright deflation? Well, sure. Even though the economy can probably withstand additional rate hikes without causing too terribly much trouble, It's arguable whether the markets can. We've already seen the first fruits with a few of those banking failures several weeks back. What happens when you change the rate structure abruptly? We're definitely going to get more of that. The only question is, do we get a lot more and it comes all at once and causes a crisis? It probably isn't going to be that case, at least for a while, because there is still too much liquidity. Plus, at least in the US, the government has already shown its hand and it's not going to let depositors at least lose money.
No, not unless it, not unless it's one of those wildfire situations where it's too many and too much all at once.
Well, then all bets are off, and then that is when the Fed pivots and runs up the white flag, and that's when you back up the truck and buy gold and a lot of other commodities.
Yeah, no doubt. Any black swans on the horizon that you can see, or are we going to have a smooth sailing through the summer?
I continue to be amazed at the energy markets. We did get a bounce somewhat in both crude oil and natural gases this week ended, but both of them are priced well under what a reasonable return would be going forward with increased cost structures and lower supplies for oil and natural gas producers. So I think that the surprise to come may still be that we get an added inflation impetus from energy prices, which are unrealistically low right now. And a lot of that has been because of market perceptions. We are going to have record demand for oil and refined products in 2023. Yet looking at the picture, you would think we're going to have a drop and that the world is going to go into recession. So maybe some of the original predictions of $100 for oil this year are off, but neither should oil be in the 60s as it was recently. The other big black swan to watch is going to be food prices. Because of a lot of the extreme weather events right now, you've got an El Nino that is causing trouble in South America. You've got the wildfires and drought in parts of North America and the northern part of the lower 48 United States. There are going to be very thin supplies of things like wheat and corn, and perhaps others in 2023 for the harvest season, and that is going to catch up in higher food prices later in the year. So there is going to be, if you want to call it a jolt, because a lot of people aren't expecting this and they've already discounted the possibility of inflation going back up appreciably. They're going to be surprised before 2023 is over that inflation has rebounded appreciably.
Yeah, I would agree on both of those fronts. I think that there is a particular risk on the energy front, and that some of the analysts that I've been reading and hearing are starting to speculate on how much more oil there is in the Permian Basin as well as in Saudi Arabia. So if we need to rev up production, and I mean we as the world, they're starting to wonder where that production is actually going to come from to meet this excess demand. So we could see energy prices take a real jut up again. And as you know, energy goes across everything in the economy, and if energy prices start to go inflationary, everything's going to go inflationary.
That's right. That's right. So again, we're in this great stagflation for the long haul for a lot of different reasons. If it is going to tip to some extreme, it would be a financial accident that briefly might introduce deflation back into people's lexicon if too many things start to go under. But then the central banks would just print more money and overwhelm that, and we could be right back to the higher inflation, but still with weakening economies. So we may see it in different forms, but take it to the bank, folks. We have long since now entered the great stagflation, and we're going to live with it for a lot of years to come.
Sounds like my life, 50-50 chance of being right and 100% chance of being wrong. So if people want to continue to follow your your thoughts as we try to negotiate through these challenging economies. How would they do so?
Very, very simple as always. Simply go to nationalinvestor.com and make sure that you're on my mailing list. People can pay to get my specific investment recommendations. If you just want my occasional rants, my broader insights on the markets, occasional thematic special reports on different things, that doesn't cost you anything. Just a couple minutes to make sure that you sign up. So do that.
Perfect. Look forward to our next chat, probably a couple of weeks down the road, as I'm going to be on the road and a couple of conferences in the next few weeks. I'll be in Quebec City at the investment event of the North, as it is called. It's from June the 19th to June the 21st. And then I'll be at the Critical Metals Forum, which is being held in Kelowna on the 26th and the 27th of June. So if you all find yourselves in those locations, stop by, say hello.
I'll look forward to hearing what you learn of both of those.
I look forward to sharing that with you. Thanks again for joining me, Chris. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.